Red Hat has been a high flyer in 2017, but recently, after its last earnings report, it took a massive 14% hit. So now the question really comes up, is Red Hat a buy at these new prices? Is it a good opportunity to get into the stock right now to provide some massive gains over the long term? Well, today we're going to go and do a deep dive analysis on Red Hat to figure out if it's a buy. Let's go. Hey, welcome back guys to another video. My name is Nick. I know you love these videos and I appreciate all the likes and the subscriptions that I've been getting from these videos. So keep it up. If you enjoy this content, drop a like. Let's hit 50, 100 likes on this video. I really appreciate all the support. If you haven't joined our Facebook group already, we're almost at 200 members now. Make sure to join in there. I do discuss some of the positions that I'm thinking of entering, even some positions I have entered. So if you do want to get more engaged with myself and the community, join the Facebook group. It's completely free. I'll leave a link in the description as well as in the comment section. It'll be the pinned comment up there. But either way, today we're going to be talking about Red Hat. We're going to do a deep dive analysis on Red Hat. We're going to figure out what this company is, what it does, is it profitable, and if it's a buy. Okay, so Red Hat, if you're not familiar, is actually traded under the ticker symbol RHT. And they're a software company that sells open source software to enterprises, so large customers. Now, they are most well known for their Red Hat Enterprise Linux operating system. So what they've done is they've actually taken the basic Linux and they've kind of done some modifications to it, and they've branded that as their Red Hat Linux operating system. Now, they also provide storage operating systems like we just talked about, applications, management products, and they also provide training on these products as well. So the way that their revenue is structured, they earn money on a subscription model with around 86.5% of their revenue coming from subscriptions and another 13.5% coming from their training and services of these subscriptions that customers sign up for. So pretty solid model, software as a service and subscription and cloud, all of the things are the future, which is why Red Hat was a huge flyer back in 2017. But now let's take a look at their competition to see how it stacks up here. So one thing that I noticed when researching this company was that they have some massive competitors. When I mean massive well-known companies. So these competitors of theirs actually generate revenue in the double-digit or triple-digit billions compared to Red Hat's only single-digit billion. So they're very small compared to what the competitors are bringing in. Now, their main competitor here in this space is Oracle, ticker symbol ORCL, and they also face competition from IBM, ticker symbol IBM, as well as Microsoft, ticker symbol MSFT. So in the last year, Oracle was actually down around 15%, stock didn't perform that well. IBM is down around 8.5% in the last year as well. Microsoft is up around 44% in the last year, where Red Hat was actually up around 71% in the last year, which makes it the best performer out of its peers and its competitors in this industry. Now, they did report their earnings last night, and their stock price did fall down significantly on the day. It was around 14% that it dropped, so now it's up around 45% on the year. But it's still outperforming its competitors even with this recent drop. Now, as expected, with an earnings report comes a lot of analyst changes. So let's take a look at what analysts think about Red Hat. So we have 11 analysts that are still bullish on the company, 1 analyst that's bearish, and 8 analysts that are neutral. Now, the average price target here over the last 12 months or so, looking from around September of last year till June of this year, is around $156, almost $157. So it still has some upside to where the stock closed at on Friday, which is around $141, $142. So there is upside in the stock according to analysts. But as you can see here, after his last earnings report, even though some analysts are still bullish on this company, they did lower the price targets that they had. So for example, if we take a look at BMO Capital Markets, they still have a market perform for this stock, but they lowered their price target from $192 per share to $177. So this of course brings down the overall average for what analysts think that the stock can be at in the next 12 months, 24 months, whatever that may be. Now, the technicals here is actually what caught my attention initially in this company, which is why I want to take a deeper look into it, look into the fundamentals. And as you can see from the chart here, after the last earnings report, it came down to test its 200-day moving average. Now, if you're not familiar, this is where stocks love to come down to test. It's a very strong level of support or resistance for a stock. So you could see the stock hover around this level for a few days before it picks a direction of moving higher or lower, depending on if bulls come into it or bears continue pushing it down. Now, if you're not familiar with all these terms, I will be making a follow-up videos on what bulls are, bears are, and all that stuff, as well as more technical analysis videos because I know you guys want that. So stay tuned for that. But either way, we also see some support here, the support trend line, which is at around 138, which also coincides with the 50 moving average on the weekly, which is also at around 138 or so. So I expect the stock to actually come down to closer to 138. And if we do come down to that level, I do suspect that there will be a lot of support in this stock. In fact, I may even think of opening up a position at that price because that would be a pretty good value for this stock. Now, of course, the obvious thing when you look at this chart is the massive gap that was just created. And I absolutely love this. I love when companies beat on their numbers, which we'll get into in a second, but the stock price still falls because they had weaker than expected guidance. Now, in my opinion, the guidance was still good. I took a look at their guidance. Still pretty solid, still up from last year. So there's no real issues there, but the stock price took a massive hit. So this is providing a potential good opportunity to get in and have some massive gains over the longer term. So let's take a look closer at their fundamentals here. So Red Hat has a current PE of around 79, which is very high in my opinion. And their forward PE is around 41, which is still very high. So this could explain why a lot of investors were profit taking on their last earnings report because they don't believe that this company can really sustain this high of a PE. So they started taking some money off the table. Now the competitors, as a comparison, have a forward PE of 12.44 for Oracle, 10.01 for IBM, and 25.2 for Microsoft. So as you can see, Red Hat's really overpriced compared to these competitors, which is why the stock is also taking a big hit, like I just said. Now, of course, Red Hat does not pay out a dividend. They're still a growth type company, and I don't expect them to pay out a dividend anytime soon either because they're trying to reinvest all of this money into their model, into their subscription model and trading model, because that's where they see a lot more growth coming in the future, because a lot of companies are switching over to a cloud-based or a SaaS or software as a service-based model. Now their balance sheet is very healthy in my opinion. Their cash and investments comes around 2.47 billion. Their debt is only around 0.768 billion, and their cash to debt ratio here is around 3.216. So that's very healthy. I love to see a cash to debt ratio at least a 3 or 4. So this is pretty much in line with what I look for when I look at balance sheets. Now here comes the fun stuff with the numbers and growth to see if Red Hat actually had some numbers to back up the run up in price that it's had over the last year or so. So as we can see from this, the revenue has been increasing consistently year over year over year. In fact, we have double-digit growth year over year over year. Now, this year they are expected to bring in around $3.4 billion in revenue versus last year's 2.92. So this again would bring in a double-digit growth for the year. So in my opinion, yes, it is slowing down slightly compared to 17%, 21%, etc. This year we might get around a low teens, maybe 12, 13 or so % growth, but that's still a good growth number in my opinion. So their operating income here has also been growing substantially. I love to see this double-digit growth in operating income. Net income has also been increasing, but it has been slowing down. The last year only came in at around 2% growth. But I do suspect that this year they will have more net income, so there will be more profits coming into the company. Now, capital spending is increasing, which did raise a bit of a red flag for me, because that's not something I want to see in a company, especially a company that's not in a retail type space or retail type sector. So I think that they really need to start managing their spending better for capital spending. And if they can do that, they can actually boost their profits a little bit more. So I'll have to wait and see how they do with this over the next year or so, but as it stands, they are spending quite a bit of money. Last year they spent around $100 million on this, so it is something to keep an eye out for. Now the last thing, of course, is the stock performance, which was excellent over the last few years. In fact, its last 1 year grew 72%, which is astronomical compared to the S&P 500 or any other index fund. So this is a great growth stock, and now with this recent dip of around 14%, it might be a good opportunity to come in because these numbers are looking pretty good. They are green across the board, and it does provide some good value here and some good potential. So it might be a good entry point right now. So now we have the graph performance here just to visualize what we just went over. You can see that the revenue has just been growing almost exponentially. It's been growing significantly year over year, and the stock price has kind of started to follow that. Their operating income has also been increasing substantially, but their net income has been relatively flat, still increasing but relatively flat. And like we just talked about, their capital expenditure has been increasing. So they do need to work out a little bit of this in the back end for their companies, because they are bringing in operating income and operating profits, but they're not being able to convert that properly to net income and net profits. So if they can figure out a better way to manage that money that's coming in, then we'll see a lot more upside to this stock. So now the question, of course, is Red Hat a buy? So in summary, Red Hat has massive competitors like we just talked about, and it's one of, if not the smallest player in this space. So they're profitable, which I like to see. They have enough cash on hand with low debt, so I'm not concerned about them going bankrupt anytime soon. But the one thing I mentioned that they do need to manage better is their spending. Now, they recently hit a 14% down day like we just saw, and this was due to poor guidance for next quarter. So like I mentioned this a few minutes ago. So Red Hat actually guided revenue for around 822 to 830 million versus the expected 854 million. So now EPS also came in at expected guidance for next quarter at 0.81, whereas it was expected by analysts at around 0.89. So both of these numbers were lower than what analysts were expecting, and thus the stock took a hit and started selling off, and we had a 14% down day as a result. Now in Q1, they actually beat on both their revenue and their EPS, so there was absolutely no concerns with its past earnings report. So now what I kind of conclude from this being that they didn't really meet their guidance expectations here is that it shows that there's some sort of turbulence in the industry potentially, and some slowdown in growth as well from what was expected. Now that being said, even if we take the lower end of their estimate at 822 million, that'll still be a 12% growth year over year from last year's quarter. So that means that they're still growing double digits again, quarter from last year, quarter to this year comparatively, and they are still showing strong growth across the board. So yes, the guidance was lower, but we are still going to see double digit most likely in the next quarter. So I wouldn't really be too concerned about that if that's the main reason you're not investing in this stock. So here as a summary, Red Hat has strong fundamentals, strong balance sheet, and has been consistently growing by double digits like we talked about year over year. So if you're looking for some exposure to a software-based company, like a lot of companies out there now are shifting to a software model, and if you want some exposure to this space, Red Hat might be a good option there. And if you want a company that's kind of taking advantage of a subscription model or a software as a service model, again, Red Hat is a good option there, because they seem to be doing this well, and they seem to have figured out a model that works well for them and is very profitable. Now, I do believe that their recent dip of around 14% is a bit oversold, even though their PE is fairly high, because there's still double-digit growth expected this year in the stock. So as long as that continues, I don't think that there's really any concern. Now, if that slows down, then there may be some concern in the company and the industry and all that. But as the economy stands right now, and as the stock stands right now, I think it's at a great entry point at its current price of around $140-ish per share. So to answer your question, pretty much in my opinion, yes, I think that Red Hat is a buy for me personally. But again, do your own research and do your own due diligence if you choose to purchase this stock. So this was actually a fun video to make because I didn't really know too much about this company beforehand, but after doing some research onto it, after looking at its numbers, it's a very tempting play, and this might get added to my either swing portfolio or long-term portfolio at some point. The recent dip that we've had and that huge gap that it created is very tempting, and I absolutely love playing swing trades that have massive gaps like this when guidance is weaker than expected, but their earnings were still strong and their growth is still there, and they're still a profitable company. I mean, pretty much everything's going for them, except their guidance was lower than expected. Doesn't really make too much sense to me, which is why I love to enter these kind of plays. And more often than not, these kind of plays actually turn out very profitable. So I might enter this, you might see this in a future video, so keep an eye out for that. Either way, guys, thank you so much for watching. Don't forget to join our Facebook group. Don't forget to subscribe down below. And don't forget to let me know what company you want me to cover next in a deep analysis video. Either way, guys, thanks so much for watching. Don't forget to invest positively, and I'll see you in the next one.